Hello and welcome to the Advance Your Wealth video series and podcast. Today we're going to be doing our Convergent January monthly market and economic update. We're going to give you some updates on our themes that we gave in our quarterly themes earlier in January, as well as some updates on the idea of what's coming next after Q1 and Q2 of this year. So let's jump into it. Agenda we're going to cover is our January market performance. So back earlier in January, we gave you some ideas on some of the areas of the market that we thought might outperform in our quad 2 forecast. We're going to give you some updates on that. Next, we're going to jump into some economic data. So we're going to dive into unemployment, GDP, inflation, corporate earnings. We're going to cover kind of a wide spread of economic data throughout the month of January. And finally, we're going to retouch on this idea of the death of the 60-40 portfolio. So after Q1 and Q2 of this year, we're a little bit more concerned about where things might be headed. And so what's going to be important to be considering for your portfolio going forward after that. So let's look at some of the returns in January. So as we mentioned back in the quarterly themes, we thought that the equities that would outperform the most would be growth focused equities. So things like tech and small cap. We thought areas outside of the US, like emerging markets, as well as commodities. We do see inflation starting to tick up, and typically commodities perform well in that environment. So let's walk through and see how things looked in the month of January. So starting with the broader market, the S&P 500, early in the month was looking pretty good, was positive for most of the month until just the very end. It actually finished the month down just over 1%. And so while overall we thought the market would do well, clearly the broader market, the S&P 500, didn't do as well. But some of the more specific sectors or areas that we thought we would do well actually performed much better than the broader stock market. So the NASDAQ, which is tech heavy, was up about 1.3% for the month. And if we look at small caps, they were one of the best performers kind of in the last couple of months of the year after the elections, and they continued their steady performance and really rock star performance in January, up almost 5%, coming in at 4.8% in January. Commodities also were a big performer kind of in the last part of last year, and they continued that performance as well into January with a 3.34% performance. So again, right on cue with what we expected. And finally, emerging markets, while not quite as high as small caps and commodities, still coming in at almost 3% return for the month. So pretty much everything that we expected to happen in Q1 came to fruition in January. So obviously, we're still very early in the quarter overall, so we'll have to see how that plays out for the rest of the quarter. But our call was for what we call quad 2, which is growing GDP and growing inflation. And typically in that environment, it's a good environment for stocks overall, but particularly growth, in particular tech, commodities, and emerging markets. So we're going to continue to expect that to play out for the rest of the quarter. One of the things though that we did see, and that you probably all saw headlines on, and we actually sent out a special email on that early in the month of February as well, is what's going on with GameStop and Reddit and AMC and some of these crazy stocks that just kind of went through the moon. GameStop in particular, was trading as low as the low single digits in mid to late 2020, and shot up all the way to $400 a share at one point earlier in this quarter. And there was a lot of news around this small retail traders that were basically trying to create these short squeezes where there was a large number of investors who were betting on the drop in value of stocks like GameStop and AMC and others. And because these individual investors and we believe other larger investors that came in later in the game started buying the shares and buying options on those shares, it drove the share price up, which then forced those short sellers to buy back the stock to get out of their short position and start to relieve the pressure of the losses they were accumulating. And it created this massive frenzy over the course of a couple of week period. And so, these are the types of things, in my opinion, that are things that happen at the end of a bull market run. Things like this don't typically happen at the beginning, when things are getting mispriced and misallocated. And so, while we still believe we're in quad 2 and expect that there's still more room for the markets to run here in Q1, these are the types of signs that give me cause for concern. And I know that from talking to a number of our clients is giving them cause for concern as well. So something we're going to continue to keep an eye on for you. So on to some economic data. Last year, we were doing weekly market update videos, and we touched on a lot of economic data, in particular unemployment, pretty regularly, as it was something that was a big cause of concern for me. And really, unfortunately, at least on the new claims for unemployment, we haven't really seen much of an improvement since December when we were doing those videos every week. On average through the whole month of January, we saw between the traditional state new claims for unemployment and the pandemic claims, we're still seeing over 1 million new claims per week coming in. We actually saw some spikes in the middle of January, as some of these spikes in the coronavirus continue to persist and continue to cause some challenges. A little bit of a bright spot is continuing claims, which continue to come down. But as we were discussing late last year, some of this could simply be a product of some of these state programs just expiring and people being unable to continue those benefits and simply just falling out of the workforce. And one of the evidence of that to me that things might not be improving as well as it looks like on the continuing claims is that total claims are still sitting at over 18 million. So we're still dramatically where we were, above where we were pre-pandemic, and still major cause for concern. So again, while we're seeing some positive signs in the economy overall, this is one of those overhangs that I worry over the long run could start to create some more problems later this year. On the positive side, though, so far in Q1, as we've been getting to see corporate earnings be released, as we got to the end of January, so just the very beginning of February, we're seeing on average corporate earnings growth was close to 4%. So this was, again, in line with what we expected to see. And we expect this to actually even get better as we get into Q2, as those numbers were really hit by the pandemic. So in Q2, they released Q1 earnings, and so we actually expect this to get even better as we get here later in the year. So it's going to be very supportive of the stock market in the short term, at least. And then if we were to look at the other key areas of our quad two call, which is rising GDP and rising inflation, we did get the Q4 GDP number, which was a bit lower than expected, although still positive quarter over quarter. It was lower year over year. And we are seeing inflation expectations come down just a tiny little bit. However, if you look at the charts, it's the rate of change is the thing that we're paying the most attention to. So even though our estimates have come down just a slight bit, the fact that they're still rising dramatically and we're going to see some massively large numbers compared to what we saw last year, all of that is still very good and very supportive for our quad two and kind of supportive of equities call for the rest of Q1. Like unemployment, though, not every number is looking as good. So if we look at consumer sentiment, we're still seeing these numbers that haven't been this low since 6, 7 years ago. And I believe a lot of this still is related to people slowly getting less concerned about the pandemic, but still having a lot of reservations. So until we get a full rollout of the vaccine, until we get people comfortable starting to use up this pent up demand that we believe is there, at least in the short term, for getting out and getting back to a little bit more normalcy, buying their cruises, buying their airline tickets, getting out to restaurants, until we see that return to really a more normal pre-pandemic type atmosphere, I believe that this consumer sentiment is still going to be somewhat muted. So looking forward, so we do believe, as we've discussed throughout this call, as well as our quarterly themes deck, we believe that the first 2 quarters of this year are going to be very positive from an economic growth and corporate earnings growth. Uh, but what happens after that? As we get into June, as we get into July, and if we're still seeing total unemployment in the high teens in terms of the millions, if we're starting to see people realize that, hey, even though we're starting to get out and get more used to things what they were before, it's still not back to normal. What happens then? And if we are seeing massive amounts of stimulus needed to be continuing to be pumped into the economy, what is that going to do from an inflation standpoint? And what's going to happen with all of these people who are struggling still to pay rent and are 5, 6, 7, 8, maybe even 10 months behind in rent payments and mortgage payments? What's going to happen when all of that eventually comes due? And so that's why we've been talking a lot about this idea of the death of the 60/40 portfolio. And just in the last couple of weeks, we released a great interview that I had with Jason Buck, who's one of the industry leaders in talking about long volatility and what comes next after what we've seen over the last 40 years. So definitely encourage all of you to go to the website or go to the podcast and listen to that interview. There's a lot of amazing nuggets that come out of that, and some of those are related to just as we mentioned, what comes after the 60/40 portfolio. And the 60/40 portfolio, for those of you who may not have listened to some of our recent videos, is this idea that over the last 40 years or so, a portfolio that was primarily 60% equities and 40% bonds has performed extremely well. And part of the reason for that is if we just go back those 40 years, we were starting from a period of very high inflation and very high interest rates and very slow economic growth. And as interest rates have come down and as inflation has come down, that has been a very supportive of strong corporate earnings growth and strong GDP growth over that time frame. And so we've had this period of relatively low volatility and pretty steady stock market increases. But now we're at a point where for those 40 years, the stock market has gone up pretty significantly and bond prices have been fantastically supported by lowering interest rates. And now we're at all-time historic lows for those interest rates. And what happens when things change? What happens when interest rates begin to go up? And what happens if we begin to see some cracks in this 40-year bull run in the stock market? And that's where this idea of Dennis Rodman and what he has to do with your portfolio. And so, in addition to the great interview we did with Jason Buck, I also released a blog post with talking about how Dennis Rodman is kind of a good example for some important asset classes you should be thinking about with your portfolio. And if we look back to the mid 90s, me as a Seattle Supersonics fan, it was a really disappointing period as my favorites, Sean Kemp and Gary Payton, made it to the finals to face the vaunted Chicago Bulls. And one of my least favorite players at the time was Dennis Rodman because he just caused so many problems for the opposing team. And he had this one particular skill set where he was massively better than almost anybody else, and that was at rebounding, and in particular at offensive rebounding. And that year with the Chicago Bulls, he averaged over 6 offensive rebounds per game. And if you think about that, that means Scottie Pippen and Michael Jordan got 6 extra shots at the basket. And at a 50% hit rate, that's at least 3 baskets made and at least 6 extra points for their team. And while that doesn't seem like a lot, if you average an extra 6 points over the course of an entire basketball season, that's going to mean a lot of extra wins, especially in tight games. And so what all that means is, Scottie Pippen and Michael Jordan together were already a great team. They'd already won 3 championships, but it made them even better to add this volatile basketball player in Dennis Rodman to the mix and made them even better. And that's what we think is going to need to happen with our investment portfolios going forward, where the traditional 60-40, as we move into a period with likely higher inflation, likely higher interest rates, and potentially, maybe struggling stock market returns after they've been so extended for so long, we're going to need to add other asset classes into the mix, things like long volatility, commodity trend, potentially precious metals like gold. So another way I like to think about some of these asset classes is the idea of the game musical chairs that we used to play as kids. And the game, if you're not familiar with it, is the music's playing and people are kind of walking around in a circle around a bunch of chairs. And when the music stops, everybody has to sit down. And each time the game goes, they take one chair away. And so one person is always left without a chair and they're out of the game. And we saw a little bit of that back in March of 2020 when all of a sudden everything correlated at the same time. So as stocks were going down, so were bonds, and so were most asset classes. And you need something in your portfolio that can be there to support you. And the way I think about it from this game of musical chairs is having long volatility in some of these asset classes in your portfolio is like you bringing your own chair to the game, meaning you always have a chair to sit on when the music stops. So we're going to be talking about this a lot more in the coming quarter because, even though we do think that the market's going to be pretty well supported in the near term, we are, cautious about where things might be headed in the future. And so we're going to be talking with all of you, our clients, on how this might fit into your portfolio and what makes sense. So keep an eye out. Definitely watch the interview with Jason Buck, read the article that we posted to the website on Dennis Rodman and the 60-40 portfolio, but definitely looking forward to talking with you more about this in the near future. So in summary, following January, we still believe that we're in quad 2 for the rest of Q1 and the same themes around tech and growth, small cap, commodities, emerging markets are still going to be the themes that we think are going to work in February. But we are, again, looking out into the future and still cautious. And so we're looking around corners and trying to start looking at how we're going to help you construct portfolios in the future after we get past Q1 and perhaps Q2 to make sure you have your chair when the music stops. So with that, I appreciate all of you guys watching the video today. As always, if you have any questions on your individual portfolio or want to learn more about some of these asset strategies that we're adding, like long volatility, commodity trend, please feel free to reach out to us at any time. We'd love to talk with you about that. So with that, we'll look forward to talking to you soon.